Welcome to our comprehensive guide on implementing asset allocation, specifically tailored for high-income professionals like doctors. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and real estate, to balance risk and reward. In this video, we'll break down the essential steps and principles you need to follow to build a robust portfolio that aligns with your financial goals. Whether you're just starting out or looking to optimize your existing investments, understanding asset allocation is key to long-term wealth. Let's dive in and explore the prerequisites and rules that will set you up for financial success. Asset allocation is more than just picking a mix of stocks and bonds. It's about creating a plan that matches your risk tolerance, investment timeline, and financial objectives. For doctors and other high earners, the stakes are even higher due to larger portfolios and complex account types. A well-structured asset allocation can help you weather market volatility, maximize returns, and avoid costly mistakes. By understanding the unique challenges and opportunities of your profession, you can make your money work as hard as you do in your career. First prerequisite for effective asset allocation is to develop a specific, detailed plan. Avoid vague targets like 60% stocks, 40% bonds. Instead, assign every dollar in your portfolio a clear purpose. For example, you might allocate 25% to US stocks, 10% to developed market stocks, 5% to emerging markets, and so on. This level of detail ensures you know exactly where your money is and why. A specific plan helps you stay disciplined, especially during market ups and downs, and keeps your investment strategy aligned with your long-term goals. Second prerequisite is to thoroughly understand what you have in each investment account. List out every account, its current balance, expected contributions, and available investment options. For example, you might have a 401k with limited fund choices, Roth IRAs with broad options, and a taxable account with access to all public investments. Writing this down gives you a clear picture of your financial landscape and helps you make informed decisions about where to place each asset class. This step is crucial for optimizing your portfolio and avoiding unnecessary fees or tax consequences. Once you've mapped out your accounts and investments, take a step back and make some observations. Notice which accounts will grow fastest, which have the best investment options, and where most of your money is held. For example, your 401k might become your largest account over time, while your taxable account offers the most flexibility. These insights will guide your asset placement decisions and help you anticipate future changes in your portfolio. Observing these patterns early can save you from costly mistakes down the road. With your plan and account details in hand, it's time to apply the core principles of asset placement. These rules help you decide which assets belong in which accounts for maximum tax efficiency and growth. For instance, place tax-efficient investments like index funds in taxable accounts and less tax-efficient assets like bonds in tax-advantaged accounts. Rebalance within tax-protected accounts to avoid triggering capital gains taxes. Always take advantage of the best investment options in your employer's retirement plans and keep future growth in mind as you allocate assets. Let's start with the taxable account. Since these accounts are subject to capital gains and dividend taxes, prioritize placing your most tax-efficient investments here. International stocks, for example, may offer a foreign tax credit, making them slightly more efficient than U.S. stocks. Municipal bonds can also be a smart choice as their interest is often tax-exempt. By carefully selecting which assets go into your taxable account, you can minimize your tax bill and keep more of your investment returns. Next, focus on your 401k accounts. These are typically your largest tax-advantaged accounts and may have limited investment options. Choose the best available funds, usually those with the lowest expense ratios, such as an S&P 500 index fund. Over time, as your 401k grows, you can shift more of your U.S. stock allocation here. If your plan offers a good bond fund, consider placing your bond allocation in the 401k to take advantage of tax deferral and lower costs. Roth IRAs are unique because withdrawals are tax-free in retirement. This makes them ideal for assets with high growth potential, such as REITs or small-cap stocks. Since you don't pay taxes on gains, you can maximize the benefit by placing your most aggressive investments here. However, be mindful of rebalancing needs. If you only hold one asset class in your Roth, it can make adjustments tricky. Diversify across accounts to keep your portfolio flexible and balanced. Let's look at a sample allocation for a $250,000 portfolio. You might allocate $50,000 to her 401k in a total stock market fund, $50,000 each to his and her Roth IRAs and REITs, small value TIPS and international bonds, and $100,000 in the taxable account split among developed markets, emerging markets, municipal bonds, and U.S. stocks. This approach balances tax efficiency, investment options, and future growth while keeping your portfolio diversified and aligned with your goals. Your asset allocation isn't static. As you contribute more each year and your accounts grow, you'll need to adjust your allocations. For example, after a year of contributions, your portfolio might grow to $350,000, requiring you to redistribute funds to maintain your target percentages. Use new contributions to rebalance whenever possible, and only sell assets in taxable accounts if absolutely necessary. This approach minimizes taxes and keeps your portfolio on track. Balancing is the process of realigning your portfolio to its original allocation. Do this primarily in tax-advantaged accounts to avoid capital gains taxes. As your portfolio grows, you may need to rebalance more frequently, especially if market movements cause your allocations to drift. Use new contributions, distributions, and as a last resort, asset sales to maintain balance. Remember, the goal is to keep your risk and return profile consistent over time. The investors make mistakes by ignoring account-specific rules, chasing recent returns, or failing to consider tax implications. Avoid placing tax-inefficient assets in taxable accounts, and don't let the tax tail wag the investment dog. Also, ensure at least one asset in each account is found in another account to facilitate rebalancing. By staying disciplined and following your plan, you can sidestep these common pitfalls and keep your portfolio on the right track. Some investors prefer a simple three-fund portfolio, while others opt for more complex allocations with multiple asset classes. Both approaches can work, but simplicity often makes rebalancing and management easier, especially if you have limited investment options. Choose the strategy that fits your personality, goals, and willingness to manage complexity. Remember, the best plan is one you can stick with for the long term. Wrap up: implementing asset allocation is about more than just picking investments. It requires a specific plan, clear understanding of your accounts, and disciplined execution of key principles. By focusing on tax efficiency, leveraging the best investment options, and rebalancing regularly, you can build a portfolio that grows with you throughout your career. Remember, financial literacy is a lifelong journey, and the more you learn, the better equipped you'll be to achieve your goals. Thanks for watching, and here's to your financial success.